Good morning, everyone. Happy New Year to you, and welcome to SmallBiz Talk, solutions for your small business. My name is Lauren Simpson. I am with the SBDC, or the Small Business Development Center, and I am joined with your host today, Lori Williams. Good morning, Lori.
Good morning, Lauren. Happy New Year. It's going to be a great year, and welcome to everybody who's joined the show.
Oh yeah, we're going to give it a couple of minutes. I see people are just coming into the room. Again, for those of you who just joined us, you have registered and now entered into the room for SmallBiz Talk. It is solutions for your small business. You are joined today with myself, Lauren Simpson. I am with the SBDC. I am running all the behind the scenes magic that occurs. And then your host, Lori Williams, is joining me as well. Let me give you a little bit of background as to who we are, who the SBDC is, excuse me, and what it is that we can offer for you and your small business. So again, we are the SBDC, the Small Business Development Center, and we're a national program with over 1,000 locations across the country. So regardless of what state you're in, you should be able to find a local office that can help you. And we offer no cost services to local businesses, no cost because it's your federal tax dollars at work. Your tax dollars are already taking care of any fees that we may incur, and so it is now free for you. Where we are in terms of like the Los Angeles area, we go as far out as like Camarillo, Santa Clarita, over to Pasadena, and then down to Long Beach. And so we cover a pretty large area. So again, if your business falls within those boundaries, please be sure to reach out. Again, we offer no cost business advising. And then we also offer virtual trainings like what you're embarking on today. And so you've joined us for SmallBiz Talk. And with that, we will have various topics that cover a gamut of things. So topics from finance to marketing to social media to everything that Lori comes up with. And now to get in contact with us, please reach out via phone, 866-588-7232, or there's also a URL. And so for those of you who are tech savvy, you can reach us at smallbizla.org/new client. And then, of course, if you found us and you're outside of the Los Angeles area or Los Angeles County area, there's a different URL. And so you'll reach out to americassbdc.org/find-your-SBDC. And with that, I'm going to take care of a couple of housekeeping rules. And so those of you who would have any questions that you'd like Lori to answer, please enter them into our Q&A. Again, all questions into our Q&A. It's easier for Lori to quickly jump in and see any questions that are happening there. And then the chat we're leaving for any links that Lori has asked me to include or any tidbits that you might need to take along with you as you're following along with Lori. And I think I have covered it, Lori. I'm going to hand it over to you. Good morning again and Happy New Year.
Happy New Year, and thanks, Lauren. And as I go through, you'll see a couple slides. I'm going to have different links to government websites, etc. Lauren's going to put them in the chat, everybody, so she'll be watching for those. So give me a second here while I turn around and get the presentation started and tell you what we're going to be covering today. Let me get... I'm always struggling with Zoom and the presentation. There we go. Let me first get the sharing. Technology is going to start out that way this year. There we go. Okay. Lauren,
Lori, I can see your screen just fine too.
Thank you so much for telling me that. I was just going to ask you that. So today, guys, once again, welcome to the show. And I always like to include a little bit about what we're talking about here. So the weekly talk show covers all types of key business topics. Some of the times I'm going to be giving instructional information, like today. I'm always going to be covering real life situations. We also have guest speakers and interviews on the show, so it changes quite a bit. And I'll be telling you about what's coming up in the next couple weeks. But for now, what we're going to do is I'm first going to talk a little bit about the EIDL loan status update. December 31st, a lot had changed. So I want to bring everybody up to date on that. And then we're also going to continue talking about preparing for the year end. I started discussing that last time where I was saying this is what's going to happen in year end as regards to legal, tax, and finance. And when I did, there were a ton of questions, a lot of responses on that topic. I went pretty quick through a summary, and I realized, and it's not like I just realized it from the show, working with small business for decades, I know that a lot of you are really confused about taxes, what I owe, what I need to do. So I'm going to cover through that again today, and also allow plenty of time for questions, as Lauren said. So go ahead and put those in the Q&A as we go through. So first, let's start with the EIDL status. Now, as of January 1st, they are not accepting any new applications. The information you're looking at right now on the screen, this is taken right from the SBA EIDL website. What I've done is I've put in bold the part that I want to emphasize here, okay? So as far as getting a new application in, that is done. Now, many of you have been working on or are in the process of working on reconsiderations and appeals. Now, if the reconsideration or the appeal was received on or before December 31st, they're still going to work through that. So don't worry if you had not heard back from them and you were in the process of it. Now, what you have to keep in mind is they do have deadlines for the reconsiderations and appeals. That's 6 months from the date of decline for the reconsideration and 30 days from the date of reconsideration decline for appeals. So if you are wanting to get a reconsideration and you got it in before December 31st, but you were past the 6 months, which isn't really too many people, but I like to have this information be presented also so there's an understanding, then you may be outside the time frame. But really the takeaway from this middle section is mostly for people who got their reconsideration into the SBA before December 31st, did not hear back from them, and I'm scared that that means that they're still not going to be considered. And I want you to know you will. They're going to catch up on that. Now, the really interesting, cool thing that I want people to know, and a lot of people are not aware of this, and that's the last section here. Borrowers can request increases up to their maximum eligible loan amount, keywords, maximum eligible loan amount. If they considered you don't have any more eligibility in the amount you can borrow, then you're done. But if you got some wiggle room yet, you can ask for this up to 2 years after your loan origination date or until funds are exhausted. It's a Congress-approved program, so when funds are gone, the funds are gone. But for many of you, you're not beyond the 2 years, and for a good number of you, I also believe, may not be at your maximum eligible loan amount. So know that this can be a future funding resource as long as it is available. So that's the part that a lot of people don't realize or are aware of. And once again, if you want to increase your loan, you can go through the portal and you can hit a loan increase button in the portal, or you can send them an email and ask for a loan increase. So that's something to consider going forward. Now, here is the information if you need to reach them or ask any questions. And what I find is that people who call on a Saturday or Sunday have an easier time getting through. So anybody that needs to get in touch with them, Lauren will go ahead and put this slide information in the chat. You've got this data. This is how to get in touch with the SBA, okay? Lauren, am I okay with going forward? Did you get a chance to grab that? Oh, I think she did.
Got
Okay,
it.
got perfect. Now, here's another big confusing question I get asked a lot: the use of proceeds for those who have an EIDL loan. And I'm getting asked this even more now, and I think it's because it's getting year end and everybody's afraid of getting audited, etc. So I'm getting a lot of people freaking out about this. So let's go over the use of proceeds for the EIDL loan. The use of proceeds, this is directly once again from the SBA website. They call it working capital. Working capital is a banking term. It's a finance term, but we also use it a lot in banking. And working capital is any funds that are used to run the business on a daily basis. And so you can see in their listing here, they've got working capital to make regular payments. Keep in mind, when you read a lot of legal terms and finance terms, every little word has meaning. You know, when we read regularly, or we're reading a book or even the newspaper or whatever, we tend to skim over words and we just read full sentences. But when you see legal copy or finance copy, you may have to pay attention to a word that seems like it's a simple word that doesn't stand out to you. Why I'm saying that, as you guys know that have come to my shows and worked with me one-on-one, I really try to educate everybody so they have a better understanding, a different perspective to look at things. So when you see this copy, this, like these first lines that I read here, working capital to make regular payments. Notice the word regular. That's a word that you might not even think, well, you just read through it, but regular has a great meaning here. These are things that you would do on a common basis. So if I had a company and I was suddenly investing in a brand new asset, a brand new piece of machinery, a brand new something, that might not be a regular payment. That's something I'm not doing commonly. I'm not doing regularly. Think about, you know, personal. I like trying to bring things back to personal situations because people understand it better. So are you making a regular payment to go on vacation? No, that's something you do every once in a while. You're making a regular house payment, right? So let's take this to a business. Regular payments for operational expenses, including payroll, rent, mortgage, utilities, other ordinary things that happen commonly, ordinary business expenses, and to pay business debt that's incurred at any time. So you're using it to pay business debt, past, present, or future. And so what this is saying is you can make payments though. When you see this section here saying pay business debt, you got to combine it in your mind with regular payments. A regular payment wouldn't be paying off a debt. You wouldn't pay off a debt on a regular basis, but you would make a monthly payment on a regular basis. So that's why they're saying it's okay to make a regular payment on business debt. Think about it like paying a loan, capital, and principal on a monthly basis. So that's what proceeds can be used for. Now, here is the big confusing question that I get all the time. Can I pay myself? Can I take an owner's draw? Do I need to get a W-2 paycheck? How much can I pay myself? This is where people get confused. So the first thing to know is if you're working in the business, notice I said working in the business, okay? Using EIDL funds to pay yourself is considered a reasonable use of funds. You know, think about it this way, guys. You have to be logical. A lot of the sole props that are service-based got an EIDL fund, and they got it based on their net profit or gross profit, depending on the timing. And most of that money was money that was actually what they used to pay themselves. So of course, you're going to be able to continue to pay yourself with these funds. You are working in the business. Now, regarding how much you can pay yourself, you want to look at what you paid yourself in the past. when you think in terms of understanding these type of rules or regulations, once again, anything government, legal, finance, you have to think sometimes when you're looking at the government type programs, what was the intent of Congress? What is the intent of the legislation? What is the intent of the rulings? So if we look at the intent of Congress, Congress doesn't want a business owner to take a government loan for COVID and make more money than they would had if COVID didn't happen, okay? Think of that in mind. They don't want you to get rich off this loan, okay? I use the word get rich as just a slang, but they don't want you to make more money. So when you say, how much can I pay myself? They want you to look into the past of what you paid yourself, the past pre-COVID, which is like 2019. So you want to review the owner draw payments. If you file a Schedule C, review your net profit line 31. That's how much you made in the year. They don't want you to pay yourself more than that in the year. If you file 1120S, review the wages compensation to officers line 7. And guys, I'm going to go over this and show you some of these forms in a bit, which you're going to see. But the concept, the takeaway is you can pay yourself equating to what you paid yourself in the past. That's what they want you to consider, okay? So Ieidl funds cannot be used to. This is the copy off of the SBA website, and people see this and they get confused. So I'm only including this to take away the confusion. So they say disbursements to owners, partners, officers, directors, or stockholders, except when directly related to performance of services for the benefit of the applicant. People look at this and they say, oh, I can't take a disbursement to an owner. They just take these 3 words and they come away with a fictitious belief that they can't pay themselves. Once again, this is legal copy and you've got to look through the whole sentence to gain an understanding. Notice what I put in bold: directly related to performance of services for the benefit of the applicant. You are the applicant, the company owner is the applicant. So that's what they're talking about here. So this is why I said, if you are working in the company, then you can pay yourself. And here, when they're talking about repayment of stockholder principal loans, and then they go into except when the funds were injected because of the disaster, what they're saying is we don't want you to borrow money at this special low COVID interest rate just to pay back shareholders that borrowed money from the company in past times. So they're not wanting you to benefit from the COVID loan. But if you're working in the company and you're not making any money right now and you need to keep the company alive, obviously, if you can't even pay yourself, you can't continue to work in the company. You have to get another job. The company dies, the company can't pay the loan. I know that sounds like I was going in circular, but I wanted you to just experience the kind of reasoning and logic behind this. It doesn't always feel like there's any reason and logic, but it's because you're not hearing the inside communication in the head, like I just said. So you have to look at it from a logical argument of why you'd be able to pay yourself. So hopefully that has put some people to rest. Now, I want to answer one of the questions that we have in the Q&A right now, and that is a person who has an application for a modification, and the SBA has reviewed everything, confirmed by email, and waiting for the transcript, which I can't get the IRS to issue. How can I get the SBA to use my filed return as proof of income? I spoke to someone who told me it takes 18 months to get a transcript options. I'm going to assume by transcript, you're referring to a 4506T. I talked about this in the last session. A 4506T form is a form that the IRS provides to anybody, which is the SBA. It can be a 4506T is used when you're in a situation of other lending, like with a bank, etc. And what it basically does is it says, hey, I am authorizing you, IRS, to send a copy electronically of my tax returns to the person, individual business that is identified on this 4506T form. And you'll see when the SBA provides the 4506T, it's got SBA written down as the person who receives the tax returns. So by providing to the SBA this signed, completed 4506T form, they then are authorized to go to the IRS and get a copy of your tax returns, which is required for any of the reconsideration. Now, there's something I want you guys to be completely aware of. The filling out of the 4506T is extremely important. It is a legal document. It must match your tax returns exactly. And when I say that, I mean, you go to either your Schedule C, if you're a Schedule C filer, or you go to your 1120S or your 1120 if you're a corporation, and you look at how the company's name is listing, how the address is listed, how your name is listed, and you make sure you copy that precisely. If you have a middle initial, you put in a middle initial. If your road is spelled out, you spell out the road. What happens is the SBA goes and knocks on the IRS door, right? And they hand them this document. If the IRS takes it and looks at their files and nothing matches that exactly, they say, we don't have it. And then it comes back that says unverified information. Now, what happened, and it has been happening, and hopefully this will change, is that it's been taking a long time for these 4506Ts to get the response from the IRS. Not 18 months though, not that amount of time. It takes some time. So what I always suggest is you can email them and respond with not only a 4506T, but also a copy of your tax returns. That gives them all of the documents up front. Okay, so that is my update on the EIDL and where to go from there. If you have any other questions, even though I'm moving on from here, I'll be monitoring the question and answer to see if anything comes up. So what we're going to do is we're going to start talking about year-end business planning. And we're going to, as I said, use this session and the next session to discuss this. So we're going to kind of go as far as we go with answering the questions, and I'm going to pick it up next year. Next week, I'm already taking another year. Now, last year, at the last show, I started talking about taxes and tax estimates, and this is where we got a lot of response. And this is the area that I wanted to slow down and further explain, because I really feel like most companies do not have this comprehension. When I was preparing for this show and really trying to delve in deep and giving people an understanding, I realized that not only do small businesses not understanding paying for the taxes, but they also do not engage in business planning as they should. And I have always been, like my soapbox statement, to go from an old terminology, an advocate, that small businesses must engage in the same type of planning that larger corporations do, albeit on a smaller level. Now, with large corporations, they are always engaging in types of planning that allows them to make sure they fully comprehend how the year went and expect what the next year is going to be like, and then they monitor it throughout the year. Very similar to the analogy we always hear about a pilot driving an airplane, that they are off course a lot of the time, but they're constantly making small adjustments to hopefully, and most time, land where they're expected to land. Companies, especially small business owners, don't think this way. They kind of put their head down, go through the processes, don't really analyze where they're getting, look up and, do their taxes, or they run out of cash and they can't make it anymore. Basically they deal with emergencies and urgencies rather than planning ahead of time. And this, like I said, is something I speak of a lot to those clients I work with. I am always engaging in how to do CFO type planning. So with that, I realized, you know what, in addition to tax planning, there's also business planning that every small company should do. So I decided, instead of just looking at the tax planning nature, I was going to address with everybody what you should do at the end of the year. Like, you know, for my private clients, as well as even my own business, when November comes around, I got a whole nother mindset. November, December, and January, I go through a thorough process every single year. And any company that is able to succeed does the same thing. So we're going to go through this process. So today we're going to talk about the payments of the fourth quarter taxes and the tax estimates, and maybe a little bit about organized financial documents for tax filing. But the next session, we're going to get into assessment of yearly performance, forecasting, and setting budgets for the next year. Now, the next slides we're going to go through a lot of information, and I tried to break it down into tiny little pieces because there is a reason that small companies don't understand this. It's not that they're lazy. It's not that they don't want to. Yes, some feel like I don't want to touch this, but guys, and you may relate when I'm saying this, I want to, you know, I'm going to say these words and see how many of you are shaking your head when I say it. It's friggin' confusing. You don't understand it. And every time you try to Google or talk to somebody, you just get confused. Okay, the reason it's confusing and you don't understand it is it's quite involved. It really is. It's one of those things, to fully be an expert on it, you got to know so much. You got to kind of be in it. And that's why many rely on CPAs solely. They don't even try to comprehend it themselves. And therefore, they just kind of base it and say, okay, let my CPA figure it out. And when I ask people questions like, why did you do this? Or what? Well, my CPA told me to. Do you know if that was the right thing for you? No, I don't even understand it. And another thing I'm a big advocate on is you don't have to be an expert in this stuff. By no means. You need to know what you're doing in your company. You need to focus on that. But don't be ignorant of it either, okay? You know, we drive cars and most of us are not mechanics. We don't know how an engine works. We don't know about the pistons. We don't know about all those aspects, right? But we know if the car starts smoking, we better pull over and not drive anymore. Doesn't mean we always do it, but we know we got to pull over, right? If we turn on the engine and we hear, we know we should get to a mechanic, right? I want you to think about the same thing. You don't necessarily need to understand all the aspects, the inner workings, but know enough to know when you're not getting the right information and you need to make some adjustments, okay? So what we're going to do is we're going to start into just some learning, some basic terminology. If you guys stay with me and hang with me in the next couple, how many minutes, I'm not going to commit, it could be a bit, you are going to walk away going, oh my God, I never knew all that existed. Now, as I'm doing this, I got the Q&A open. I'm seeing you put your questions in. And if you get something that I'm talking about and you get confused in the middle, I'm going to try to interweave some questions into it. So guys, here we go. So we have to understand tax terminology and their meaning. So some of this I mentioned in the presentation last time. I'm repeating to give some foundation. Some of this is brand new. So the IRS is a pay-as-you-go system. Now, that sounds like I would have made that up because it's so slang sounding, but I didn't. That's how IRS determines itself. It's a pay-as-you-go system. So basically what that's saying is the IRS does not want you to go along the road earning money and not paying in intermittently. Think about how employees are taxed. You do not get a weekly paycheck that does not have taxes removed, and the IRS says, yeah, go ahead and take it. You know, I know you need the money. I'll catch up with you at the end of the year. No, you get a paycheck that you see this gross amount and you see the net amount. We all can think back to when we had our first job and we knew we were getting so much, and then all of a sudden we get this paycheck in our hand and we look at it and we're like, where'd the money go? And people go, well, FICA and taxes, and we've learned about taxes. So IRS has a pay-as-you-go system, okay? So that's one thing to understand. Now, another aspect is taxes are based on your legal structure. So when we think of taxes personally, we know that you're taxed based on whether you're single, whether you're married, if you have children, if you have a house. We all personally understand that. But the part that we don't necessarily fully comprehend is that there is also different taxing structures based on how you are legally organized. Now, we know this a bit because we hear things saying, well, you should be an S Corp because you can save on your taxes, or you should be this, or you should be that. But unfortunately, once again, this is a subject that when I talk to SBDC clients, so many people understand there's a tax based on a legal structure, understand that some legal structures may be more tax advantageous, but they don't know it enough, and they have a lot of misconceptions. And some people are switching their legal structure based on a tax savings that isn't even true and actually causing more harm to themselves. So we're going to talk a little bit more about that. But right now, the understanding is that your taxes and how much you pay is going to differ on these legal structures. Now, sole props, LLCs, and S Corps, we've heard the word pass-through entities. This means that they're taxed on a personal level, and people read this, but what does that mean exactly? Well, what that means is that, first of all, the amount of tax liability for the company is considered, then that amount transfers onto the personal tax return, and then the tax amount owed, the amount you would pay or be refunded, is going to take into consideration both a number from the business and the numbers from the personal. We're going to break this down more, but that's what it means to be a pass-through entity. The company itself doesn't pay in the taxes, the person pays it in. And think of it like a big, huge bowl. So you throw in all these different pieces for this recipe, you mix it all together, and then you determine how much is actually owed or refunded based on what's in this big mixing bowl. And so what we're going to do is we're going to find out and learn what are the ingredients that are going in this mixing bowl. So your legal structure may be different from how you're taxed. I just told you a minute ago that you're taxed based on your legal structure, but you could have a legal structure that is determined by the state you're in. Most of the people on this call, state of California. So if you're a corporation, you filed with the Secretary of State from California, and that is your legal structure. But then you can tell the IRS to tax you differently than what your legal structure is registered. So you could say, State of California, I want to be an LLC, and set yourself up accordingly as an LLC. Then you can file a form with the IRS and say, IRS, I want to be taxed as an S Corp. So you're basically doing two different things, and you have to have a consciousness and understand that you are still legally an LLC, but you are taxed as an S Corp. So you need to have a full understanding of that. Once again, I go back and I talk with a lot of clients, and they don't understand. They're on like LLC. No, I'm an S Corp. You got to understand which you are registered as and which you are taxed as. So the legal structures pay different types of taxes, okay? And the amount that you are going to owe is going to be based on the company's net profit. Okay, the amount of tax you're going to be owed is based on the company's net profit. So the first thing we want to do is understand what I mean by that. So the net profit is the amount that is going to be remaining after all tax deductions are considered. So after you take all your tax deductions and you take and remove them from your sales, that is going to be your net profit. The final amount of tax liability for the company is after all tax deductions and credits. Okay, so let's break down that understanding. So net profit, not revenue. When we are talking taxes, we are talking first net profit. So here is the simple formula. You have the revenue, which is also called sales. I like to put all the different nomenclature in so nobody's confused. I always, say, people ask me, why are there so many names that mean the exact same thing? And I always tell people it's because then us in finance can keep you confused and we can charge more per hour. That's my finance joke, guys. But what we're talking about here is the net profit, not the revenue. So when we take revenue and sales, we want to subtract the cost of goods. Cost of goods are those expenses that are directly, once again, keyword, directly related to the production of your goods or services. So say I made chairs, the cost of goods would be the wood, and it would be the nails and the glue, and it could be the labor involved in making that chair. Hey, if I did a consulting service, I may not have any cost of goods. I don't have any raw materials. I don't have any cost of goods engaged in it. So you may or may not have cost of goods, but cost of goods is subtracted, and then overhead expenses, that's like your rent and your marketing expenses, your insurances. Then you get to net profit, and that is what is subject to taxation. So independent of your business legal structure, sole prop, LLC, S corp, whatever, it's all dealing with net profit. Once again, I talk to clients and they say about tax, and they go, well, our sales went up this year. Well, if your sales went up and you actually made more money, net profit, your taxes could be higher, but you really have to look at this net profit line, because sometimes people's sales have gone up, but their cost of goods or overhead expenses went up as well. So their net profit did not significantly change. So that's the first thing you need to know. This means come November, December, you want to start looking at your internal financial documents to see where you are with your calculations, where you are with the net profit. We'll talk about that a little bit more next week, but just something to put in your mind is that in order to understand where you're going to be from a taxation standpoint, you're going to want to understand your net profit. You don't want to wait until January to learn this. You want to know this throughout the year. You want to know this every week. This is part of what I talk about with internal analysis that you want to have so you know exactly what's going on, okay? Now, I also said this word, I said after credit and deductions, okay? I said net profit, but then I said after credit and deduction. So what does that word mean? So once again, here is the link to the website. Lauren, take off the WHT I see on the link. It repeated itself, so you just get that link. So what is a credit and what is a deduction? These are two words that people use together, and they're actually separate things. So let's learn what that is. So when you claim federal tax credits, this is from the IRS website, by the way, so I'm giving you the actual words. I really like people to get an understanding of the terminology, and then I'll explain it. So if you go to this link, you'll learn all about credit and deductions. So when you claim federal tax credits and deductions on your tax return, basically what you're doing is you're changing the amount of tax you owe. So a credit and a deduction is lowering your tax liability, but these do different things. They are different things and they do different things. So the first thing is a deduction. They reduce the amount of income before you calculate the tax you owe. I just communicated deductions to you. I talked about overhead expense. I talked about cost of goods. I'm even giving you another example like home office deductions as you calculate things. So I just previously, when I gave you the formula and we talked about net profit, I discussed deductions. Those are tax deductions. They are subtracted from the revenue before you calculate your net profit to identify your tax liability. Now, credits are something else. A credit, most of you don't experience on the business side, but a credit identifies what is removed after you figure out the tax you owe. So you might say, I owe $1,000 in tax, and then you can apply a tax credit. Think of like opportunity zones. These are tax credits given to businesses that are located and have employees within certain low income areas. Research credit, think about some of the employee tax credits that we had during COVID. So basically a deduction is a deduction like you would look at in your own financials before net profit. A credit is something that would be applied after your tax amount is determined. It would be a further reduction in the amount of tax you owe, okay? So I think everybody's with me so far. So the net profit is the amount remaining after all tax deductions are considered, the final amount of the tax liability for the company. Notice I said company is after all tax deductions and credits. So now you kind of understand where we've come to from the business. So we've looked at the business financials, we looked at the net profit, we identified if we got any credits, and we know that that is the amount that is now subject to tax, okay? So we understand the business. Now, once you understand the business, then you have to go and identify the person's overall tax structure. Because remember I said that a S Corp, an LLC, partnerships, these are all pass-through entities. So when you get all of the business calculation done, that final amount, say at the end, my net profit is $10,000, okay? I'm just making up numbers. I always just make up numbers. That 10,000 gets transferred over to my personal. So guys, I want to go back to my bowl, my recipe. I'm making a recipe of tax here, right? So we got this bowl. So I take the net income and I throw it in that bowl. Now, say the 10,000's in there. I may have different situations personally. Say that I have my company and I also work as an employee somewhere, part-time, full-time, what have you. I have a W-2 wage that gets thrown in the bowl. Say I'm married or I have a domestic partner and that's considered within my tax, that gets thrown in the bowl, right? So all that's going to be considered gross income is going to be everything now from the business as well as personal mixed up in this bowl, right? And then on a personal level, we have credits and deductions. So I want you to think mortgage, kids, all of those different aspects on a personal level. Then once you get down to the very, very bottom, that's when you finally identify that this is how much I have to pay in, or this is what a refund goes. So this is the whole process of looking at the company first, then looking at the person to figure out what is owed. That's why it's kind of impossible to identify what you're going to owe before you do all the work of looking at the company, looking at the person, looking at all this. And that's why CPAs ask for all these documents, and you find out sometime into the following year what the actual number is. But that doesn't mean you can necessarily wait till the following year to figure out how much you owe, because remember, we got to go back. IRS is a pay-as-you-go system. Remember, we talked about that at the beginning. And taxes are based on your legal structure and how you're taxed. We've got that now. We know that the legal structures pay different taxes and amounts. And we now know we need to know when and how those taxes are paid, and how overall taxes are considered through the pass-through entities. So we've learned a good foundation now. Well, now let's take it one step further, okay? So I've got to give you some information again. I got to give you some knowledge. So this is to do with legal structure terminology. And you know how I've been saying these tiny little words that seem like they really don't mean anything. I've pointed that out several times. They really mean something. Here's some more words that seem like you're just saying words, but guys, these words have a lot of implications, okay? So here's something I want you to know. Sole prop, LLC, partnerships, when you think of them, they are considered self-employed person or persons if it's a partnership, okay? So I want you to picture that there's three people sitting in the room and they say, okay, I want you to write on a little plaque that we're going to put up in front of you, how are you legally organized in the state of California or whatever state you're in? So somebody might write, I'm a sole prop. Somebody else might write, I'm an LLC. And somebody else might write, I'm a partnership, right? So we've got these. Now what happens is the IRS comes in and says, self-employed person on the sole prop, self-employed person on the LLC, self-employed person on the partnership. In other words, what I'm saying is the IRS is not seeing these three entities any different. They're taxed completely different. I'm sorry, they're taxed completely the same is what I wanted to say. So often I hear people say, well, I'm going to move from a sole prop to an LLC so I can change my tax structure. There's no difference in tax structures, guys. These are the same. Sole prop and LLC changes the legal risk, but it does not change tax structure. So the word I want you to remember, or words I should say, is you are self-employed person or persons if it's a partnership. All are taxed the same. Now, if you're an S Corp or a C Corp, this is different. You are an employee of the corporation. Notice, employee, E-E-E, big word here, big here. You are an employee of the corporation. The type of legal entity determines the type of taxes paid. Real important. So let's look at a chart here. So if we look at the types of taxes, we can say, who pays what? Well, an employee pays federal tax. This is your, federal tax that you owe. An employee pays Social Security, but so does an employer. An employee pays Medicare, so does an employer. An employer pays unemployment on the Fed level. This is on the federal level. The employee does not. So you can see that if I am an employee of the corporation, I'm going to have to pay both the federal, the Social Security, and the Medicare. But if I'm an employee of the corporation, that means as an employer, okay, of an S Corp, I have an employee, even though it's myself. So I'm an LLC, taxed as an S Corp. I, Lori, am the owner, the employer. I, Lori, am the employee. So I have to pay as an employee these, as an owner, I have to pay these amounts. So you can see there's a difference in how the employee and the employer relationship of an S Corp, mainly in this, notice that the unemployment insurance is not paid by a self-employed person. That is why during the pandemic, unemployment insurance was allowed for sole props through the Pandemic Unemployment Assistance Program. When you are not an employee, the employer is not paying in unemployment insurance for you on your behalf. That's why you can't collect it. That is why during the pandemic, the only way people could get unemployment insurance that were not an employee of either a company or an S Corp owner was to have the pandemic unemployment paid by Congress. In other words, Congress reimbursed the state for what was not paid in. Now, if we look at California, you have a state tax. They call it personal income tax. Pitt, you got to laugh at that, okay? You know the joke there. It's the Pitts, right? But anyway, so you, as an employee pays in the California, an employer pays in unemployment, and employer pays in what's called ETT, employment training. I got a typo there, employment training, and a employee pays in state disability. So right here breaks down what you have to pay in depending on your legal structure, okay? So when we talk about tax estimates, let's talk about tax estimates for a second. I'm going to go in this one slide, then I'm going to answer some questions. So I want you to think about tax estimates because everybody says, do I have to pay in a tax estimate? We know what taxes you have to pay. We know that the IRS is a pay-as-you-go system. So do I have to pay in tax estimates? Now, the very first thing we have to think about is tax liability is dependent on net income, net profit. That means the same thing, once again, changing out words, but it's net profit. So if you have zero net profit or a loss, you have no tax liability. So therefore, you have to kind of understand where you're going to be by the end of the year in profitability to know if you have to make estimated tax payments. That's why a lot of times what happens is people do the analysis prior to the end of the year to do an estimate so they can get it in to avoid this underpayment penalty. So what's an underpayment penalty? I like to explain this is that an underpayment is a rule that the IRS uses to have businesses follow the pay-as-you-go system ruling. So let me tell you what I mean by that. If I was an employee, I would follow the pay-as-you-go system because it would be taken out of my paycheck, wouldn't have a choice, right? But when I'm a business, I don't have anybody taking it out of my paycheck. So IRS doesn't have as much control. So what they do is a lot of things are rules that are controlled by penalties. I want you to think about like a speeding ticket. If it says do 55, how do they make sure people follow that rule or try to make sure people follow that rule? They do it by creating a penalty, a speeding ticket, if you don't abide by that rule, okay? So an underpayment penalty is a similar way. It's a speeding ticket if you don't abide by the rule. And this underpayment penalty is about all businesses and all individuals, right? And what it says is that you either have to pay 90% of the current year or 100% of the previous year by the end of the year to avoid an underpayment penalty. So what does that mean? Say it's getting to the end of the year. I know I have net income. I know I'm going to have to owe taxes, and I don't have the numbers to figure out what my 90% current amount is. Well, then what I can do is I can say, how much did I pay last year? Well, this is the amount. I'll pay that exact same amount in a tax estimate. Therefore, I won't have an underpayment penalty. If you're going to owe more or about the same, it's going to even out. If you're going to owe a little bit less, you may get a refund. If you're going to owe a lot less, you might want to pay a little less and go more towards the 90%. So it's easy, you give some wiggle rooms. So what a lot of times CPAs do is when a company in the previous year owed, you know, I'm going to make a small number, okay, so I can do it, $12. So they'll say, well, pay, you know, $1 a month, pay $3 on a quarterly estimate. That way, by the end of the year, you'll pay $12. You'll pay 100% prior year. And they set them up with the coupons. So a lot of business owners are accustomed to getting these quarterly payment tax coupons that they have to pay in. And many of them have no clue where that number comes from. And it comes from a tax estimate to make sure that you paid in 100% so you avoid an underpayment penalty. And that's what that's all about. Now, if you're an S Corp, there's an additional requirement. You must take what's considered a reasonable wage. And by the end of the year, if you have net profit of like 10,000, a reasonable wage is usually identified just as a generality about 50% to 60% of the net profit. So I would have to take about 5,000 of that as a salary and do a W-2 and run all of the taxes that the employer, as I just told you, would have to pay in. I have to get all those taxes paid in. So when we talk about year-end planning for taxes and whether or not you need to do tax estimates, it's all revolving around this underpayment penalty rule. Now, where I get to, there's two main things I see big mistakes. A person didn't owe any taxes previous, right? So then what happens is they then make a profit. They didn't pay any taxes in, but they didn't pay any in last year. So on the 100% prior year, they're okay, right? But that new year, this new year, they did have to pay taxes in. They have this belief they never have to make tax estimates, which really was a result of having not been profitable, not a result of the IRS rule. So if the new year they had to pay in taxes, they have to make tax estimates for the following year if they're going to be profitable again. And a lot of times people, I actually have clients say, well, the IRS doesn't require you to pay tax estimates. You can if you want or not. No, that's not true. It just so happened that you had not been profitable. So you had no taxes owed. 100% of the prior year was zero. You didn't have a tax penalty, but a lot of CPAs and enrolled agents do not explain this properly to their clients, and and they come back with a misunderstanding. Okay, so I'm going to stop there to answer some questions that we have here. I don't understand how I can pay quarterly taxes when I need all this information at the end of the year. I think I answered that. So that was perfect. I didn't even notice it before I read it. So it's so confusing. That's exactly why I said it. You did not have in your back pocket the 90% current year or 100% prior year rules, which, you know what, I don't talk to too many small businesses and they go, well, I'm basing it on this, you know, and CPAs, like I said, they don't explain it. So now that you have that in your back pocket, you fully understand what's going on. If we have an LLC business and there were consulting projects paid through the LLC, is this taxed as part of the business before it funnels into the personal taxes? I'm not sure what we're meaning by consulting projects paid. I'm going to assume that you're saying income coming in. So it's basically a pretty easy rule. You know, what happens is a lot of people ask questions with these unique situations and everything, and they think, well, this is always unique, but it really comes down, it's either income or not. So if the corporation or the company or a sole prop is getting paid, that's income. Income is coming in and considered as income. And if it's income that you identified through your business structure, for example, if you were a sole prop, an LLC, yes, it's income. If you did some babysitting and you just made some additional money on a personal, but that's not what we're talking about here. So for whatever reasons you get paid, you made money, that comes in underneath the company. And that analysis that I walk through with revenue minus expenses equals net profit is first calculated before it goes in the company. See, guys, it's a pass through, right? And so people get confused and they take that mixing bowl and they take the mixing bowl and they put everything in the mixing bowl first, where you saw I went through and I said the business, and then I took the net income and I put it into the mixing bowl. Then I put the personal stuff in the mixing bowl. So you notice how I made my recipe. In fact, a lot of times CPAs will be clear and say, we first have to figure out your business, then we do the personal. This is why you got to have the end piece, the recipe ingredient in the mixing bowls, the net profit from the company. Okay. I am a sole prop filing Schedule C. I filed my 2020 tax return on October 13th, 2020, and I still have not received the tax fund from the IRS. Do we know how long it takes? You know, they take all different amounts of time, and with COVID, it's been different. But what you can do, and I don't have the link in front of me, but if you want to, and Lauren, when I send it back, she'll give you the information to get in touch with me. By the way, I meant to say this, guys, to those that have gone through Lauren, your emails get to me, I see them, I respond, so know that you are getting to me. So if you get an email to me that I can respond to you, there is a page on the website of the IRS, if you cannot find it, that you can check on your refund. You can actually Google, you know, refund status, and it asks you to put some information, and it won't say you're going to get it on this date, but it'll say it's where it's in the process. So you might want to try that website on the IRS to get some more updated information. Okay. Let's see. For 2020 and 2021, we expect a net loss. Therefore, as an S Corp, there will not be a reasonable wage, no taxes due. Is that correct? Correct, because you know the concept, and I'm going to go into a little bit more detail on an S Corp with one of the presentations here, because it's really involved, and I'm just kind of sliding it in here. But in S Corp, the reasonable salary is based on net income, right? So once again, you just follow the rule. So follow the rule. If you should take at least 50-60% of net income, and net income is zero or a negative number, what is 50 to 60% of it? Zero or a negative number. You can't take that. So what happens, and the reason I said it this way, guys, it sounds like I said it strange, but follow me on this. If you learn these basic rules and apply them, you won't get all these crazy thoughts in my head. Well, is reasonable salary if you don't make money? Well, no, reasonable salary is, you know, somewhere around 50 to 60% of net income. Net income zero, that's zero. No. So that way, if you know every one of these questions, always go back to a rule. Okay. Talking about income, the PPP is considered an income. PPP forgiveness is not considered an income in the way that we're asking the question on this. What happens is the PPP forgiveness is not considered a taxable income, and the deductions that you took for the forgiveness part, like, you know, you took a certain amount of salary and then you might have taken rent or whatever, those are still deductions. So the answer is no, the PPP is not considered income, and the deductions that you took to gain the forgiveness is also allowed as a deduction on your income tax return. And while we're on that, I'm going to extrapolate on it. I always tell you from my experiences of dealing with SBDC clients, everything I learned. What happened with that is, at first, the federal IRS determined that those deductions were allowed to still be taken off federal taxes. California was slow behind, first saying they wouldn't be, and then coming back and saying, yes, they would. Okay. I have had people who filed their own tax returns not know that and not take the deductions off their California tax returns, because California decided it late in the game. I'm talking about now for, what is it? I get confused on my years, for 2020. So know that that was deductible. Those deductions were still able to be taken as a tax deduction in California and on the federal. And the other thing I want to say is that be careful, and we're going to talk about this next week when I talk about QuickBooks record. Too many of you guys made mistakes. You put the money into your QuickBooks bank account, right? Whatever the bank account was. QuickBooks picked it up as income and you didn't separate it. You give it to the CPA enrolled agent, and if they aren't doing their due diligence, they don't know that it's a PPP loan. And I've seen people tax it as income because they gave the tax preparer incorrect information. So that's another thing that I'm always wanting to check on, is to see if you have accidentally put the PPP money into your income category when giving your information to the tax preparer. So you want to make sure that that does not done. Okay. That is 2020 already done. CPA reported net loss passed through to personal taxes. I'm not sure, that might be a continuation of something. I don't know where the question is on that. So I'm going to kind of pass and assume that you're just confirming something. And if I miss something, just type back in and let me know. We're going back to a question about the Ieidl, I believe it is. So I'm going to read that real quick. I have run into the same issue regarding the tax transcripts. Remember, guys, this is regarding the first, at the beginning, I was talking about the 4506T. I applied for an increase at the end of September and submitted the 4506T to the SBA at least 5 times now. They ended up declining my request because they claim the IRS came back with no records, even though I filed the 2019 returns. Now I'm waiting on copies to be sent to me by the IRS. I called and they confirmed they have the IRS returns. I filled out the form correctly. Is there something I'm missing? I'm going to suggest that you go back and just double check that the form matches your Schedule C or 1120, because I don't know what kind of business structure you are, but that tax document exactly. You may have filled it out like it was personal, right? But maybe, like, for example, say I'm Lori Williams, and say, let's pretend I've got a Schedule C and I call my company a DBA, Lori Williams Great Company. I got to fill it out Lori Williams Great Company because that's the name the company is under. Now, say I put on my tax return Lori's Great CO period instead of Lori's Great Company, and I put on the 4506 Lori's Great Company, that didn't match it. I put on the 4506 Lori Williams, that didn't match it. Say I've got my business as one address and then my personal is a different address, and I put my personal address on, did not match it. So it may be that it did not match as exactly as you thought. Pull out the tax return document for the company and check the 4506T. Now, another thing I want to tell you is that I get this a lot. They're confused. I'm like, I gave the SBA the 4506 10 times. How many times do they need it? They need it every time they have a correspondence. So don't think that this is a one-time deal. I want you to think of it differently. Have you ever called your bank or somebody and they say, do I have permission to access your account? I know everybody's heard this. They've heard, do I have permission to access your account? The 4506T is that sentence. So if I call the bank and they ask me, do I have permission to access your account? I say yes. If I call them next week, they say, do I have permission, right? So the 4506T is when every correspondence, they have to get a new one to access it. That's why they are asking for it again and again and again. Don't even question it. Just fill it out, check to make sure it's correct, and send it in, okay? That's how it is, okay? Let's see, where are we? Oh my God, it's amazing. The time goes by. We're going to keep the questions for next week. Next week, we're going to continue with this learning process where I'm going to continue to talk about tax estimates, but I'm going to delve into the other type of planning that you need to be doing year end. And this is where we're going to get into business planning. How profitable were you? What are your forecasts? What are your budgets? What type of Excel documents should you be doing every year at the end of the year and throughout the year? And then the following week, we're going to have a great guest coming on to talk about different things that she experienced and learned when growing her company. I'll be giving you more information about that next week. So once again, I'm going to send this back to Lauren in a second, but we'll keep all the questions you've asked. I got some questions that people sent in as well. So we've got them. You're either going to be hearing from me or I'll be answering them on the show. So don't feel like you're going to get missed in any way. Please communicate with us, reach out with us. Lauren's going to tell all the information on that. So Lauren, I am going to pass it back to you and say thank you to everybody for being on the show, but you're up, Lauren.
Thank you, Lori. Another wonderful show. So much information. It was so good. Thank you. And thank you to all of you who have joined us. I am going to list the link for you all to share your questions. And so we have a form. I know there are a few in the Q&A that we didn't get to today. So I've copied those down, but I'd also like you all to fill out our form to ensure that we receive all of your questions and get all of your needs taken care of to the best of our ability. Again, we will see you next week, Wednesday at 10 a.m. We're going to be continuing today's topic, and we have tons more in store for you. So again, thank you to you, Lori. Thank you. And to all of you who've joined us. I'm going to enter that link in just a second. So Lori, have a wonderful, wonderful day. Thank you.
Thank you. Bye, everybody. See you next week.
Okay, bear with me. I'm going to get that link to our form and then also get you all a link to our YouTube. And on our YouTube, you'll be able to see our past shows. So there's that link to enter questions. Excuse me. Let me do it one more time. Looks like it got cut off. Any questions you may have for Lori, be sure to enter it into the form that I just linked in our chat, or you can send an email to lsimpson@lbcc.edu. I've entered that into our chat as well. Again, any questions or any needs you may have before our next show next Wednesday at 10 a.m., please send an email to lsimpson@lbcc.edu, or please use our form to add questions there. And we look forward to seeing you next week. Thank you so much. And again, Happy New Year. Bye.